the fastest growing middle class in the world. 3 billion, 9 billion. That's pretty solid. Holy cow, this thing's super expensive. And it hit 58 and bounced up from there. Alibaba is on a tear lately. China has been on a tear lately. Why? This whole COVID restriction stuff has really got people scared, and then they loosen their COVID requirements, et cetera, and the stocks have skyrocketed. I own Baba shares, and my covered calls have done terrible on them. Why? Because the stock flew on me. Let's go pull it up in our software. Now, guys, remember, I'm here to teach a process. I own Alibaba. That doesn't mean you should go out and buy Alibaba. You need to do your own research. I'm here to teach you how to fish. I don't want people who just say, Paul, give me the fish. That's not going to work for me. That's not going to work for you in the long run. If you're here to learn a process, you're going to love it. So let's take a look at the stock here. Hit a high of 319 on October 27th of 2020. So a little over 2 years and 2 months, 2 years and 6 weeks ago. Hit a low of $58. $58. Now, the interesting part is, if you watch some of our past videos, Mo was talking before it hit $58, that $58 was kind of based on the charts, the kind of resistance point. And it hit 58 and bounced up from there. That's a process that we look at. It's not going to determine our value investing ideas, but it's something that's very interesting when it comes to charts. All right, so the company market cap is $293 billion, enterprise value of $355. So basically that in between number, the difference is debt. They have a 5-year PE of 20, a 1-year PE of 143. You're probably like, holy cow, this thing's super expensive. Maybe. We're going to take a look at that though to understand it better. A very low return on invested capital. Again, you're probably like, why does Paul like this company? He's an idiot. Maybe so. So let's go check out their 8 pillars. All right, not a high ROIC. Not a great shares outstanding. Net income has fallen. That's probably what attributed to their high current PE of 143, but a reasonable 5-year price to free cash flow and a reasonable 5-year PE ratio. Okay, so it's like, okay, there's some positives here. Now let's go actually look at the income statement. Look at this company. So revenue, 3 billion, 9 billion, $126 billion it did in the last 12 months. That's a lot, guys. A lot of growth there. And it's basically the Amazon of China. And look at China's economy. They have 1.6 trillion people. It's the fastest growing middle class in the world. And they also help people all around the world buy from their suppliers in China, India, all over. We use them for buying goods from overseas, containers of goods. So there's a lot of value there. Now let's go look at the profit. Now here's the interesting part. 1.3, 4.3, 9.2, 4.8, 9, 9, 22, 19, 18, 2. So if you're looking at this right now, do you think this is a normal number? Remember, we want to buy based on normalized earnings, not based on some fluke high year and not based on some fluke low year. You want to sit there and say, listen, if I own this company for 10 to 20 years, what's it going to make in that time, right? So if you're new to the channel, there are 3 questions I always ask. 1, do I think this company will be around for 10 years or for the foreseeable future? The answer on Baba for me is yes. 2, do I think in that foreseeable future, they will make more money or less money than they are today? I think more. The third and hardest question to answer. Can I pay a reasonable price today for the company based on that future that gives me an adequate return on my capital? That's the one that you should say no to 95 or 98% of the time, but you're looking for those few percentage points where you find it and say, yes, that's the one I want. So we have to do that with Alibaba. Now, let's go look at the analyst estimates on Alibaba. Now, our analyst estimates come in a different currency. But it's not important to really, what I'm looking for is the growth levels here. So analysts expect, low double-digit growth over the next 4 or 5 years in terms of earnings per share. In terms of revenue, not so much. It's not growing as much, but let's see what their gross margin is. Their gross margin is about 36%. By the way, if they're the Amazon of China, Amazon's gross margin is 12.9% right now. They have almost triple the gross margin that Amazon has. That's pretty solid. Bottom line, 5-year margin, about 16, 17%. All right. So I think the analysts are wrong here. I think they're being too negative in the company because a lot of times when a company's stock falls or goes up, analysts have a pressure to go accommodate their assumptions based on what the stock has been doing recently. And that's the big thing here that I want to sit there and factor in. Like, do I really think that Alibaba is going to be raising revenue by a couple percentage points a year in the next 3 or 4 years? No. I don't. The market for China is just way too large. And remember, I'm here to own the company for a long period of time. So I'm gonna do something different on the stock analyzer tool. So this stock analyzer tool is the most popular part of our website. 1.3 million uses of it last year alone. 1.3 million. Our community is awesome. These people use it every single day. We share our screenshots of our assumptions. Now, I'm actually gonna do a 20-year analysis on Alibaba. Because I sit there and say, I want Alibaba and I want to own it for a very, very long period of time. So let me go make my assumptions for the next 20 years. I'm going to make more conservative assumptions because as you got further and further and further, it's less likely that you hit really big numbers. So I'm going to be more conservative, but I want to see how quote unquote cheap Alibaba could be today. Okay. So the very first line, what's my revenue growth? All right. Well, let's see here. They did 42.8% revenue growth a year for the last 10 years. Spoiler alert, probably not going to happen again. But I'm going to be conservative. I'm going to call it 4, 7, and 10%. Because I think just where they are right now, they should grow revenue 4% a year. And they're able to grow for the next 20 years, 10% a year. That would quadruple. I don't know, what is that number? It takes their revenue up how much? Let's see here. Come on. So 1.1 to the 20th power, 6.7 times. That's a big jump. But guess what? The world's growing. China's growing. Fastest middle class in the world. China will probably be the world's largest economy at some point here in those next 20 years. Now, not on a per capita basis, but on a total basis. And when you look at where China stands economically, they have a lot of growth potential. So I'm banking on that. I'm not even touching the rest of the world on it. All right, profit margin. All right, so the profit margin is actually down as time went on. Why is that? I don't know. But I'm going to sit here and make my conservative assumptions again. I'm going to go with 15, 20, nope, 15, 18, nope, 15, 18, and 21. And the same thing with, actually, I'm going to go 15, 19, and 24 and 23 on free cash flow because they had some bigger free cash flow margin years. All right. Now, PE and price of free cash flow. Historically speaking, the average PE is about 15. Now, I'm going to do an audible here. Usually I look at that return on invested capital and say, oh, it's too low. It was like 5.8%. This stinks. And the growth rate sucks. I just think the market's getting it wrong. I think there's just been a lot of negativity on China and Alibaba. Again, guys, this is my personal opinion. It doesn't necessarily mean I'm right. You have to do your own research on it. But when I look at this, I'm going to be a little bit more aggressive, I think. I'm going to go 14. Actually, you know what? Because it's China, I want to be a little more conservative. 13, 15, and 17. And same with price of free cash flow. Because I look at China going, it's still another country. And I'm not going to understand that as well as I understand US businesses, right? So I still have to be a little conservative in that regard on the low side. That's the key here. Don't force the numbers to happen. There are 10,000 companies out there. Your job is to make a low, middle, and high assumption on all those companies and find the ones that fit your wheelhouse. That's it. If it's not this one, find another one. That's the point of the software. It allows you to screen and run through these companies very, very quickly to find the ones that make the most sense. So with that, go to everythingmoney.com. You want to sign up. We have a great offer, a money back guarantee. Sign up for it now. Within 30 days, if you don't like it, email us, money back, no questions asked. But I think you'll end up sticking around. Now, finally, for our desired annual return, this is basically your margin of safety because you can get 9 or 10% by investing in a long-term ETF. So in order to buy an individual stock, especially one in China, you should have a little bit more meat on that bone. Get yourself a little bit more margin of safety. So for this one, I'm going to start with 13, 15, and then go to 17% because the higher my assumptions, the less likely they're to happen and the more margin of safety I need. And the higher desired return, the lower the price, right? Because if I pay less for something, my return's higher. If I pay more for something, my return's lower. Now, the stock's currently at 114. I'm hitting the analyze button. Boom. We have a low price of 85, high price of 160 to 170, a middle price of 120 to 125. Now, keep in mind, my cost basis, I believe, is like 150. So I'm still in negative this one. And according to this, I have to hit my high numbers here. And that very well could be the case. But that's why I wasn't buying the company at freaking 300. Because I was like, I think it's growing, but it's got to assume a lot of great numbers. Let's go change this real quick to a 10-year analysis. See how that affects the numbers. It might drive it up a little bit more. Yeah, a little bit more. We have a low of 87, a high of 165 to 180, and a mid price of 120 to 130. So guys, this is Alibaba. Go do your research on it. If you don't feel comfortable with China, do not even look further. Just move on to the next one. But remember, subscribe to the channel if you want to learn a process and want to learn how to find great investments, not just be told what one could be. Thank you very much for your time.